like to get into this case here in investment news. This is another topic discussing life settlements, which is a very interesting sort of investment opportunity, I guess you can call it, in a sick and funny way. It says, SEC fraud case could give new life to life settlements controversy. So, just to define it, a life settlement involves the sale of an individual's insurance policy to an investor, and they depend greatly on life expectancy estimates. So the longer an insured person is expected to live, the more investors must continue paying in premiums on the policy. Further, life settlement specialists charge more for policies belonging to persons with shorter life expectancies. Now, this is just the new level over here because you're basically hoping somebody dies and you're waiting for that payout. Now, from the investor's perspective, this is kind of an interesting situation. But from the insured person's perspective, this is even more interesting because now you got a lot of investors waiting for you to croak, which is an interesting position to be in. I've always told people, don't be worth more dead than alive because that could be dangerous in itself. So it says the SEC claimed that life partners used life expectancy estimates allegedly provided by an unqualified doctor with no actuarial training that were too short by at least 8 years, leading to inflated revenues and misleading shareholders. The Commission also claimed that the company failed to disclose the use of underestimated life expectancy data. So basically they're saying they used bad tables and that's the problem. But is there anything that we're not going to securitize these days? Is anything sacred anymore? I mean, now we're literally waiting for people to die. There's also derivatives based on weather, if you can believe it. You know, some providers sell these so-called insurance policies that, let's say you're a car wash and you're expecting a rainy day. And nobody's going to show up and get their car washed on a rainy day. So what you do is you buy a little insurance policy and it says, okay, I'm going to pay in the premium, and if it rains, I get a payout, which should cover my losses for the day because nobody's going to get their car washed. On the other hand, if it doesn't rain and I get the customers, I just pay the fee and I lose the premium, which is a clever way of doing things, I got to admit. We have derivatives based on weather now. We have life settlements where life insurance policies are being securitized and so forth. So it's just a whole new level. This is something I really didn't even know about until I came across the story. So it just came out January 4th. So that's another interesting issue. I guess at some point this might become more popular because everything tends to, as soon as people have a way to get cash, they tend to do it. But I'm sure the heirs are not too satisfied with this whole scenario, right? You know, you expect a nice payout at the end, and now an investor somewhere around the world is getting that payout instead of you. So I guess that could be a little bit of a disappointment, but that was the investment news story on life settlements.